It's happening! I was right! Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of July 5th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. This week was really good in the stock market. We gained almost every day aggregate on the S&P 500. Everything was flying. My portfolio was falling. There was a lot of volatility with Citius Pharmaceuticals this week, and Virgin Galactic was up and down for a couple of reasons. I'll talk about both of those things today. Also, I do appreciate you guys for showing a lot of love to MTN. I went there for my third live on-air interview last week. Also, there's going to be some more cross-promotional content coming from me and MTN. We recorded enough YouTube content to make 2 or 3 videos. They're working on subtitling them, and the first one should be up sometime this week, so I will share it with you guys through my Twitter and my YouTube community page. I know I'm a little bit behind on my comments. I'm sorry about that. I was able to get through all of my comments from my video 2 weeks ago, but I still haven't had a chance to start from this week. It's been a bit of a crazy week in my real life, so I'm sorry about that. I will get to it as soon as possible. Without further ado, let's get started with the news. I think the most sensational news story of the week is brought to us by ARK, no big surprise. On June 28th, ARK filed the ARK 21 shares Bitcoin ETF with the SEC. We don't know when this is going to start trading. It's going to have to be approved first, obviously. But when it does start trading, it's going to be traded under ARKB. The ticker is going to be ARKB. 21 Shares is a Swiss-based finance agency related to cryptocurrencies. They have some really cool offerings on their website related to specific currencies. They also have like 75% of all cryptocurrencies in a fund called HODL, HODL. They have an inverse Bitcoin ETF in case you're actually a Bitcoin bear. You can invest in that. So 21 Shares has a little bit of something for everybody who's interested in cryptocurrency. ARK is going to be teaming up with them to get a Bitcoin cryptocurrency ETF going in America. Cathie Wood's ARK Invest is going to create a Bitcoin ETF under the symbol ARKB. Wood, a longtime bull, has been buying up proxies for the digital asset in names such as Coinbase and the Grayscale Bitcoin Trust. Now the innovation investor is seeking to own the actual asset itself. The SEC last week again postponed a decision to approve the first Bitcoin ETF. The latest action comes as SEC Chairman Gary Gensler has called for more regulation of cryptocurrency exchanges and greater investor protections. Wood and ARK are no strangers to Bitcoin. If you look at the ARKW ETF, you'll see the Grayscale Bitcoin Trust and Coinbase both in the top 10. I think as of close of trading on Friday, Grayscale Bitcoin Trust was like rank 7 in ARKW and Coinbase was around rank 10. So this is something that Cathie Wood has been talking about for a long time. She's almost as big of a Bitcoin bull as a Tesla bull. Now we can only speculate which companies are going to go into this Bitcoin ETF. Obviously, something like Coinbase is a logical choice. Something like Mara, something like Riot, those ones are going to be good ones to go in. Probably Support.com as they're merging with Greenlane, which is a cryptocurrency miner in upstate New York. I imagine that's going to find its way into there. But who knows? It's ARK. Maybe we'll see John Deere and Netflix and yet another ARK ETF for reasons. This isn't exactly a new thing. There are already some Bitcoin ETFs on US exchanges that you can trade. ARKW, like I said, this one has the exposure with Grayscale Bitcoin Trust and Coinbase. Simplify US Equity Plus GBTC ETF. This is a weird one. It's basically got like 2 holdings, the S&P 500 SPY and Grayscale Bitcoin. And the SPY is like 75%. The Grayscale Bitcoin Trust is like 25%. So if you like the S&P 500 and you like Bitcoin, this Simplify ETF might actually be a good one for you. And then the last one is the Bitwise Crypto Industry Innovators ETF, BitQ. This is kind of the coolest one, and this is what I imagine ARKB is going to end up looking like. If you look at the holdings for this ETF, you have MicroStrategy, that's the company that's investing heavily into Bitcoin itself, Riot Blockchain, Coinbase, Marathon Digital Holdings, Galaxy Digital, Hive Blockchain, Blockchain, Voyager Digital, Argo Blockchain, Hut 8. None of these are really surprising, and honestly, I expect ARKB to look a lot like BitQ. The problem with BitQ, however, is the assets under management. It's not a very liquid ETF. Right now, it only has about 55.5 million assets under management, which is low for an ETF. For comparison, ARKW has 6.3 billion assets under management. Now, when you're looking at investing in an ETF, two of the most important things to consider, after obviously the holdings, are the management fee of the ETF and the liquidity, the assets under management of an ETF. ETFs are typically slow movers in price, so you want a highly liquid ETF so that if something happens and you have to close out your position, there's likely going to be another buyer for the entire ETF. Think about it like you're shopping in a grocery store. If you go into the grocery store, buy a 12-pack of Bud Light, you can probably sell that Bud Light to somebody if you really needed the money. But if you go into a grocery store, buy an entire shopping cart with like 30 different items, you're gonna have a hard time selling somebody those 30 items unless that's exactly what they're looking for. And that's kind of how I view illiquid ETFs. I look at an illiquid ETF like BitQ and I think, wow, if something happens to Bitcoin or something happens to cryptocurrency, who's going to want to buy an ETF representing all of those currencies? It's not really going to happen. But ARKW already has 6.3 billion assets under management, and you can imagine ARKB is probably going to be over $1 billion within the first couple weeks of trading. Who knows? Maybe the first couple days of trading. So I think ARKB is going to be a net positive for Bitcoin. I think the ARK name, the ARK image, even though they're having a rough year, it's really going to translate to a high AUM for this ETF. Just a reminder, Bitcoin is struggling a little bit, but it seems to have found some support around the $30,000 level. Just a couple months ago, in the middle of April, we ran all the way up to 64,900. Right now, we're floating around 34,000. So it seems to be holding pretty strong support, and it's not like Bitcoin's going anywhere. Next news story, Robinhood is to pay the $70 million fine after causing widespread and significant harm to customers. Popular investing platform Robinhood has agreed to pay nearly $70 million to FINRA to settle allegations that the brokerage caused customers widespread and significant harm on multiple different fronts over the past few years. There's really no reason to go into the specifics of this article. Everyone is aware of how shit of a brokerage Robinhood is. You get free trades, but you end up paying for them in the markups that you don't see, the order flow that they're selling, and the brokerage just seems to randomly overload and shut down on big market moving days. During the COVID crash, Robinhood shut down like twice when people were trying to sell their assets, and some people were claiming this caused them monumental losses. And I mean, probably there's a huge black swan event, a market crash of that magnitude, and you can't unload your shares to anybody for any price. Yeah, that's kind of like the one thing a brokerage is supposed to do. It's supposed to provide that service, and Robinhood has failed. They failed with GameStop and AMC. I know it was Apex Clearing that told them to stop selling, but in January, Robinhood did not fulfill any duty to its clients, its account holders, which made everybody realize, hey, Robinhood's real clients aren't actually its account holders, it's companies like Citadel that buy its order flow. During the Dogecoin run-up and subsequent sell-off, Robinhood ended up having another freeze at that point. Oddly enough, Robinhood is one of the largest holders of Dogecoin, so that's a little odd, but suspicious coincidences aside, you guys could see Robinhood's having some problems, and a $70 million fine is actually a pretty big deal for a company that barely turned a profit last year and is still relying heavily on external investors for funding. More bad news for Robinhood this week. Feds seize Robinhood CEO's phone in GameStop trading halt investigation. Robinhood says it's being widely investigated over its role in January's GameStop bonanza. Who writes these things? Bonanza? It's subject to at least 49 class action lawsuits. The company said its CEO, Vladimir Tenev, has also had his cell phone seized by federal authorities. The investigations are ongoing. In its filing with the SEC, Robinhood states that the fallout from these restrictions still have the potential to be disastrous for the company. We've become aware of approximately 50 punitive class action lawsuits relating to the early 2021 trading restrictions. The complaints generally allege breach of contract, breach of implied covenant of good good faith and fair dealing, negligence, breach of fiduciary duty, and other common law claims. Several complaints further allege federal securities claims, federal and state antitrust claims, and certain state consumer protection claims based on similar factual allegations, the S1 states. Robinhood is having a bad time right now. To remedy this, Robinhood is going public, probably this week or the next. We don't have the date for sure, don't quote me on that, but they've already filed their intent. They're looking to raise $100 million with their public offering, which is going to slightly more than offset the $70 million that they're having to pay to FINRA for this fine that I just covered. Robinhood is just bleeding money, something that I found to be absolutely shocking. On their filing to go public, they recognized that their user base increased over 300% early in 2021, and yet their net revenues were down $1.4 billion. This company has a problem making money. They have a PR problem. They have an image problem. There's a going concern, not with the financials necessarily, but with the legal implications and fallout from everything that's been going on. I am not going to touch the Robinhood IPO with a 10-foot pole. I'm not going to touch it with a 20-foot pole. I'm going to be avoiding the Robinhood IPO like it's the Delta variant incarnate walking around on the stock market. I'm not going to short it because the IV is going to be insanely high and options are not available upon IPO immediately, but I'm just not going to do anything with it. It's obviously a last-ditch effort for the company to raise some of its own money, but with all of this bad PR, I can't imagine anything positive coming out of their IPO, and it really just reeks of desperation, of a desperate attempt by a company to stay afloat. The US cannot afford housing market boom and bust, warns Fed official. You don't want too much exuberance, says Eric Rosengrid, amid fears over hot property sector. It's very important for us to get back to our 2% inflation target, but the goal is for that to be sustainable. He's the president of the Boston Fed. For that to be sustainable, we can't have a boom and bust cycle in something like real estate. Now, he covers his own ass by saying, I'm not predicting that we'll necessarily have a bust, but I do think it's worth paying close attention to what's happening in the housing market. According to data released by the National Association of Realtors last week, the median price for sales of existing homes, not new homes, existing homes, was up 23.6% year on year in May, topping $350,000 for the first time. This is the craziest part of the entire article. In the Boston property market, it has become common for cash-only buyers to prevail in bidding contests, and that some have been declining home inspections to gain an edge with sellers. Yikes, that's rough. Going cash-only in bidding removes any need for a bank inspector to look at a property during the auction, removes any need for a safety inspection for the house, and also declining the safety inspections is effectively an admission saying, I don't care what quality the house is, I just want to buy it, flip it, resell it. That's kind of the exuberance in the market that he's warning about. And I know that's just the local market in Boston, but that is kind of terrifying. And that is like, that's kind of a sign of the top of the market, if I do say so myself. And I can understand why he is saying this. But why don't we want this boom or bust cycle? Why don't we want home prices to go down? I have one hypothesis about this. When interest rates are so low, borrowing goes up. That's the whole point of low interest rates, to stimulate the economy through borrowing. Debt becomes cheap. And remember, debt isn't always a bad thing. If you appropriately apply debt, you can get a great return on capital. There's something called a HELOC, a home equity line of credit. A home equity line of credit is not exactly, but it's effectively like a credit card line that you open against the equity of your own home. For most people, their home is the most equitable position they have, and it represents a large percent of their net worth. So, in a housing market where home prices are soaring, it is very tempting for homeowners to open up a HELOC position, a home equity line of credit, borrow against the value of their own home, and then do something with that money. Historically, during periods of low home valuations, HELOC usage is really low. But in 2021, with home prices rising 23.6% just this year, HELOCs are on the rise. And in fact, I came across a couple articles this week from different financial institutions promoting HELOCs. So it stands to reason that we have all of this debt taken out right now against houses that started this year. And if we have a bust in the housing market, a lot of people are going to be in a lot of trouble with debt because of that. The other reason this causes trouble is, let's say a home has $100,000 in equity, $100,000 remaining on the mortgage, and a HELOC line of credit for about $10,000 out. If the homeowner is forced into selling, the value of the home goes to paying off the mortgage first, and that leaves the HELOC owner high and dry without being able to get their money back. So this creates a void in the market where some people just aren't getting paid. And this causes causes an imbalance, which can cause greater ripples throughout the entire stock market. A couple weeks ago, I talked about margin debt being really, really high. I would also not be surprised to see HELOC debt really high because debt is so cheap right now. Next news story, Facebook's market value surpasses $1 trillion for the first time. I don't really have too much to say about this, but you could see Apple's at 2.25 trillion, Microsoft we just covered is 2.02, Amazon's 1.74, Alphabet, Google's 1.7, and Facebook just crossed over 1.01 trillion. You know, we talk about it all the time, the FANG, I don't even know the acronym anymore, Facebook, Apple, Amazon, Netflix, Microsoft, Google. Netflix is not at the $1 trillion mark yet. I don't even think it's that close, but Facebook did just join that $1 trillion club and good for them. But this is kind of a weird one for me. Objectively, I look at Facebook and I see they just print money as an advertising platform. They're incredibly effective for some reason, and somehow their user base is still growing, even though almost everybody I know personally has moved on from Facebook. I keep my account live just because it has become almost an archive. I think I created my Facebook account back in 2005. My university was one of the first universities that started running with the Facebook trial. So I quite literally have over 15 years of history recorded on my Facebook account. For that reason alone, I can't really bear the thought of deleting my account. It's almost like our parents and our grandparents had those photo albums. They would take them out to look at occasionally and remember the good old times. I do that with my Facebook account, and I flip through all my drunk pictures of clubs, blurry pictures, and chugging beer and everything like that from the tailgate parties. But I don't like Facebook. I think it's a predatory business. I think the way that they operate their data collection is unappealing, dishonest. They've already faced issues with that. They've faced some antitrust issues with the acquisition of Instagram, their other acquisitions. I don't think it's a moral company, but I do think it is a financially sound company, and I am quite happy for anybody who is holding Facebook. The growth really speaks for itself with Facebook. We're at an all-time high right now. During the COVID drop, Facebook ended up dropping as low as $137.10, and currently we're sitting at $358.14. Facebook has almost tripled in less than 18 months. This is insane, and their financials are absolutely incredible too. If you look at their net income, 9.5 billion last quarter, 11.2, 7.85, 5. They're just printing money. That being said, I still don't hold any Facebook outside of ETFs, but I can't blame anybody who does. Virgin Galactic versus Blue Origin rivalry escalates with Branson set to beat Bezos to space. What have I been saying for like the last month and a half? Richard Branson wanted to be up by his birthday and he was gonna beat Bezos into space. It's happening. It's happening. I was right. Space stock initially soared, then paired gains after Virgin Galactic announced late Thursday that it would fly Branson aboard the first fully crewed flight of its spaceship to space plane on July 11th. The flight would come just 9 days before Bezos' first space flight, which is scheduled for July 20th. There was kind of a cute back and forth here where the Blue Origin CEO Bob Smith responded to this schedule change by pointing out a technicality. We wish him a great and safe flight, but they're not flying above the Kármán line, and it's a very different experience. The Kármán line is about 62 miles or 100 kilometers above Earth, and it's seen by some expert as the boundary between outer space and the upper atmosphere. Virgin Galactic's space flight hits around 90 kilometers, but the US Air Force and NASA define that key boundary at 80 kilometers above the Earth. Obviously, the CEO of Blue Origin was just saying this, poking fun at Virgin Galactic. I don't think anybody's going to quibble over a difference plus or minus 10 kilometers. I can't wait for the July 11th launch. Space has just had an absolutely wild ride over the last week plus. We ended up getting the big spike off the FAA clearance going all the way up to 57.51, and then we returned back down to a low of 43.19, and then we spiked back up to an intraday high of 54.40, and now we're back down to 44.94. The stock is swinging by like $10 every day. I mean, 20%, 25% gains and losses every single day. This is not something you commonly see with a larger market cap stock. I just want to quickly address the jobs market and give my take on it. The US added 850,000 jobs in June, better than expected. The expectation was for 706,000, so this was actually a really big beat. But the unemployment rate unexpectedly unexpectedly rose 5.9% versus the 5.6% estimate. Most of these gains happened in hospitality with 343,000 and education with another 269,000. These jobs gains in hospitality and education are not really surprising. We are in the summer season and a lot of US states have lifted any restrictions for COVID. So hospitality is probably adding seasonal jobs. So this 343,000 number doesn't really excite me because it's summer. These are most likely seasonal jobs that are being added on and they're going to be gone by the end of summer. I don't actually see this as being hugely positive. Also, the education jobs, June, July, August, that's when most US schools are hiring their new teachers, their new staff for the next year. So any schools that started early in June with their hiring process got the bulk of their applicants filled. That's going to be reported in that 200,000+ figure. So a lot of this really looks just not realistic to me, and I'm not too excited about it. Also, the increase in unemployment from 5.6 to 5.9, that's not good. Honestly, I feel like a lot of tech companies and a lot of the more volatile companies in the stock market looked at that increase in percent of unemployment and they were like, yeah, let's do it. Not that they're celebrating a lack of jobs, but as long as unemployment is still increasing, the Fed is absolutely not going to raise interest rates to curb inflation. They're going to wait for that unemployment figure to go down before raising interest rates. Next news story, I just want to touch on this briefly. Citius Pharmaceuticals announces positive recommendation by Independent Data Monitoring Committee to continue the HELOC phase 3 trial as planned. This is something that the market reacted to very poorly. Citius Pharmaceuticals, a company I did a DD video on. They're a late stage clinical trial company with their flagship product in phase 3 testing. The DMC's interim safety committee was evaluating the phase 3 process, and historically, sometimes the DMC does end a phase 3 trial early, but I ended up going back and looking at the data. That actually happens a very insignificant amount of the time. Most of the time, the DMC just tells the company to proceed with their phase 3 trials as planned, proceed with their recruitment as planned, gather all the data, and we'll evaluate at the end of the trial. That's what happened here. This is totally normal. The DMC for the HELOC phase 3 pivotal superiority trial is recommended proceeding with the trial as planned. The DMC did not identify any safety concerns and no modification were recommended to the protocol to find sample size or power to achieve the primary endpoint. This marks the third recommendation by the DMC supporting the continuation of the HELOC trial. With each DMC review, the hurdles to meet our protocol defined criteria for safety and superior efficacy increase. Consequently, this favorable outcome indicates that based on our predefined parameters, it would be possible to achieve our primary endpoint by continuing the trial as planned, and is an encouraging signal when combined with the results of our prior studies. Keep in mind, phase 2 for HELOC was 100% effective, so everything is on track, everything is on pace. The DMC said, you guys are doing fine. Keep it up. Come talk to us when you're done. There's nothing bad here. The only thing is the market is really impatient and Citius Pharmaceuticals ran up. People were expecting a bigger pop on the DMC review and it ended up having a sell-off. So anybody who bought the top is now going to be bag holding probably until December or something when phase 3 finishes. Thankfully, I'm up on my position still significantly. Anybody who bought in around the time of my video is also up significantly on their positions, but I can see why some people who don't have patience and were expecting the trial to finish at this time are a little upset about this. On June 22nd, we hit the high of 456. Since then, we've been just dropping like a rock, and currently after hours, we're sitting at 214. Remember, these are human lives at stake with these medications, and you want to get it right. Brickell Biotech announces the final patient completed in the first US phase 3 pivotal clinical study and the patient enrollment completed in the second US phase 3 pivotal clinical study of sofpironium bromide gel 15% for the treatment of primary axial hyperhidrosis. I covered Brickell Biotech on my last DD video. This is just a little update. The last patient was completed for Cardigan 1, which was their first phase 3 study. They have everybody enrolled for Cardigan 2, which is their second phase 3 study. Everything is on pace for Brickell Biotech. Everything's good. I just wanted to include this short update. Nothing else to say here. Next news story is actually coming from Reddit because it's a translation of a Chinese language article. I know I don't read Chinese. I'm sorry, guys. I'm really dropping the ball on that one. China Steel Corp in Taiwan, management confirms the likelihood of the rumored China steel export tax in July. It's likely for China to announce the export tax on or right after July 1st, which is the CCP's 100th anniversary celebration. We didn't get it yet, so probably the beginning of next week. Both China and Russia are essentially forced to roll out a series of policies to combat domestic commodity price hikes. In addition, according to the article, if and when that happens, Chinese steel will vanish from the global market. The steel shortage will be worse than the chip shortage we've seen. All manufacturers will be scrambling to secure supply and capacity. This is hugely bullish for steel. Effectively, China is going to be charging its own steel manufacturers a 15% or thereabouts export tax on its own steel. That's a large enough figure to where nobody's going to want to buy Chinese steel. Now, this has two effects for China. It's going to accelerate their own infrastructure growth because sellers are going to have to look for internal buyers at lower prices. It's going to help curb inflation in their own country, and it's kind of changing like a China first mentality within the country. So I understand why the Chinese government is doing this, but this is really going to exacerbate shortages for the rest of the world because China is a very large steel manufacturer. Bullish for Cleveland Cliffs because they're going to be able to charge more money for their steel, and the prices for steel are going to be increasing outside of China. Last week, I covered the options play on POWW Ammo Incorporated. Their earnings were spectacular. There was a little bit of a price pop after the earnings. Some people tweeted at me they got out of their options with really high percent gains. I didn't sell mine yet because I think the company still has more in the tank for a future run. Annual adjusted EBITDA was 8.1 million, adjusted EPS of 7 cents per share. Sales for the quarter, 24.2 million, an increase of 409%. Gross profit margins increased 23%, an increase of 179% year on year. Operating expenses decreased. EBITDA increased almost 300%. EPS increased to 4 cents, which was an increase of 167% year on year. Also, that EPS was 500% higher than the analyst projections. They were projecting -1 cent on the EPS, and this beat it obviously by 5 cents. I don't want to badmouth analysts, but in my mind, this was such an obvious win, especially after seeing the Smith & Wesson earnings report, hearing what their CEO was saying about the industry. We looked at all this last week. I don't understand why the analysts were projecting so low. Like, in my mind, this earnings report is what was expected, but hey, you know, I'm just a guy on YouTube, so take that for what it's worth. POW on their earnings, you could see the big gap up here when the earnings report was released. We ended up closing the day before at 8.79. The day after, we opened almost a buck higher at 9.45. We ran as high as 10.37 before coming back down. We still haven't gone as low as we were when I initially covered the company, so we're holding some gains, and I do think we are establishing a new uptrend, and the company is going to be going up from here. Let's take a look at the upcoming earnings for this week. It's terribly boring. This is probably the most boring week. It's the last low density earnings report week of the quarter. Of course, Monday, the stock market is closed for the 4th of July holiday weekend. Tuesday, we've got Smart Global Holdings, MSC WD-40, Helen of Troy's a big retailer, high-end retailer, Levi's. I mean, the only thing on here that even excites me a little bit is Accolade. Accolade is a software company that provides healthcare solutions, and it helps streamline health treatment, healthcare, medical, dental, pharmaceutical, everything works through the Accolade platform and the Accolade services. Accolade has been gaining on their net income for the last couple quarters, and it's actually looking like this earnings report, they might report their first positive net income quarter in company history. I'm going to be looking at that, seeing if they end up doing that, but I don't know enough about the company to really make a play on it. Out of everything that's reporting this week, Accolade is the only company that I'm even a modicum excited about, and yeah, it's really boring. You know, I try to give you guys an options play of the week every week, but this week there's nothing there, and I'm not going to force it. When you start forcing something like an options play around earnings with higher IV, you're really just begging for trouble, and I'm not going to do that. So what I actually did this week is I looked ahead to next week's earnings, the companies that are reporting, and I did find something really promising that I'm going to be purchasing options in the week before its earnings report. Let me go ahead and spin the yarn, give you guys the tail of the tape, talk about what's going on from a macro perspective. The world's largest aluminum producer is still short of metal. We already talked about China today, increasing steel taxes on exports, keeping the steel steel in the country. Guess what? China is also the world's largest aluminum producer, and they don't have enough raw materials. China's share of the global aluminum output has increased in the last couple months from 40% to near 60%. One country, 60% of the global output, gives you an idea. China is currently short of aluminum raw materials, with the imports of both primary metal and alloys still running strong. The country's flip to net importer last year initially looked like a COVID-19 recovery disconnect, similar to the one during the global financial crisis more than a decade ago when China last needed to tap international supplies, but net Chinese imports are starting to look like the new normal as the global economy steadies from the depths of the coronavirus crisis. The country that's responsible for 60% of the global aluminum production has flipped in the last 2 years from being a net exporter to a net importer. It doesn't take a genius to realize this creates a strain on the global aluminum situation, and aluminum is used in everything from high-tech materials to auto parts to lightweight building materials to food containers. Aluminum is everywhere. This is the article that I saw this week that made me interested in this as a play. So aluminum rises as Russia's new export tax fuels supply concerns. Russia is preparing new export taxes for steel products, nickel, aluminum, and copper, and Moscow-based Rusal is the world's largest aluminum producer outside of China. This is coming out of India, saying Russia and China are both announcing export taxes. Right now on the London Metal Exchange, 3-month aluminum, so the spot aluminum price is about $2,523.50 a ton. The Shanghai futures for August are already up to almost $3,000 a ton. The futures for next month are already up 18% above the current spot price. The aluminum market is about to explode even higher. The United States is going to start requiring licenses to import aluminum from Monday, which is going to support higher prices. The United States is paying a premium on aluminum, and this is the highest level since October 2013 because of these import licenses. Here is the aluminum price chart back to 2017. You could see we're at all-time highs right now. This is per ton. These are the spot prices, $2,500-ish. And for the options play of the week, I give you Alcoa Corp, which is one of the largest aluminum producers in America. If we take a look at the IV right now, the implied volatility is not much higher than the historical average. We're at 54, historical average is 42.80, so the options contracts are not much more expensive than normal right now. Right now it's rated as a moderate buy with 4 strong buys and 3 holds, so 4 analysts are super bullish, 3 analysts are pretty neutral. And something else, on this earnings report that Alcoa is going to be giving here in 2 weeks, Alcoa just completed the sales of 2,100 acres of land in Maryland, which is going to be netting the company another $90 million from this transaction, and that's going to be reported on their next earnings report. So just $90 million in extra revenue for the divestiture of that land that they weren't even using on their next earnings report. So this right here is going to be worthy of a couple percent boost on the earnings report. I want to show you guys something. Now this is the Alcoa chart going back to mid-2017. This is the aluminum chart going back to 2017. We've got rise, peak mid-2018, fall off for coronavirus, peak now. Rise, peak mid-2018, fall off for coronavirus, peak again now. The Alcoa aluminum chart perfectly mirrors the spot price chart of aluminum. Futures are already 20% higher, and for the last quarter, aluminum has had almost record prices for the last 3 months. This Alcoa earnings report is going to be incredible. The only thing that worries me slightly is that they offer lower guidance going forward with the peak aluminum trading season being over in autumn, but I don't see that happening because the taxes from China and Russia on exports are going to put a strain on the system, and this is not going to be a normal year for aluminum. So I'm expecting an earnings report beat. I'm expecting positive guidance going into the next quarter, and I'm expecting Alcoa's price per share to rise sharply. If we look at the options ladder for Alcoa, I'm actually not even going to go really far out like I have in the last few plays. I'm just going to be going out to September. I'm going to be looking at these $38 calls in September. Right now selling for $365. I'll probably be buying a couple of call options here for Alcoa, the $38 in September. If we look at the chart right now for Alcoa, you can see the RSI is kind of in the middle. It's a little bit above 50, but this isn't really something to worry about. We are uptrending. The MACD is not looking great, but But we've been pretty positive for a long time on the MACD, and off a good earnings report, this could flip really easily. Remember, the MACD is not very predictive. The RSI is more predictive. Once again, I'm going to be getting the September 17, 2021 $38 calls on Alcoa aluminum. I think this is going to be a strong earnings report with strong future guidance, and this is due to the macro situation of aluminum in the world, with China and Russia restricting exports, China becoming a net importer of aluminum, not a net exporter, and Alcoa is going to be absolutely slammed with orders, with back orders. Their production is going to be maxed out, and I'm feeling pretty strong about this one. And this is not really company specific. I could pick any aluminum manufacturer. It's just this one has the potential to give the best returns because their earnings are coming up soon. So it's going to be giving us an idea about the state of the market. As always, I want to thank you guys for watching the video today. I hope you enjoyed it. If you want to support the channel, check out my Webull referral link below the video. If you create an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel. If you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe, invest well. I wish you green portfolios for the future to come. Have a great week. See you next time.